Your credit score used to be a gatekeeper. Now it's becoming a sorting mechanism. And if you're on the wrong side of that sort, you're not just locked out, you're paying more for everything. Here's what's happening. Lenders, landlords, even utility companies are moving away from that single three-digit number as the only thing they look at. Sounds good, right? More factors, more fairness, more chance to prove you're responsible. But here's the catch, and this is what most people aren't talking about. The system isn't getting fairer, it's getting more layered. And if you don't understand what's replacing that credit score or working alongside it, you're walking into 2026 blind. By the end of this video, you'll understand exactly what's changing, why it puts more financial pressure on people who are already stretched thin, and what you can actually do about it right now. Because with rent still climbing, inflation squeezing every paycheck, and emergency costs hitting harder than ever, this shift isn't just some future trend. It's affecting approval decisions, interest rates, and deposit requirements today. So let's break this down. For years, your credit score was pretty much the number. FICO score between 300 and 850. Lenders used it to decide if you got the loan, the apartment, the phone plan. Simple, brutal sometimes, but simple. Now, companies are layering in what's called alternative data. That's things like your rent payment history, your utility bills, even your bank account activity. On the surface, that seems helpful. If you've been paying rent on time for 3 years but have a low credit score because of one medical bill that went to collections, maybe now you get a fair shot. But here's what most people miss. Alternative data isn't replacing your credit score in most cases. It's being added to it. So now you're not just being judged on whether you paid your credit card on time. You're being judged on whether your checking account dips below a certain balance, whether you've had an overdraft fee, whether your income is consistent, or if it jumps around because you work gig jobs or hourly shifts. And here's the problem with that. The people who need credit the most, the people living paycheck to paycheck, dealing with irregular income, or recovering from financial emergencies, are the same people whose bank accounts look messy. Not because they're irresponsible, because life is expensive and unpredictable. So yes, your credit score might matter a little less in terms of being an automatic no, but the overall judgment is getting harsher. You're being watched more closely. And if your financial life doesn't fit the clean, predictable pattern these algorithms are looking for, you're still getting hit with higher rates, bigger deposits, or flat-out denials. Let me clarify something important. This isn't some conspiracy, it's just risk management. Lenders want to reduce their risk, so they're pulling in more data to make better predictions. But better for them doesn't mean fairer for you. It just means they're more confident in charging you more if you look risky on paper. And that brings us to the second piece of this. Even when your credit score does still matter, the standards are shifting. A 680 used to be decent, not great, but decent. Now, in a lot of lending environments, especially for mortgages or car loans, you're seeing that same 680 get treated more like a 620 used to be. Higher interest rates, bigger down payments, stricter income verification. Why? Because lenders are tightening up. They see economic uncertainty, they see more people carrying credit card debt, more people behind on car payments, so they're being more conservative. Which means unless your score is in the mid-700s or higher, you're starting to feel the squeeze. But here's what really stings. While your credit score might carry a little less weight in some decisions, it's becoming even more punishing in others. Take rental applications. Landlords in competitive markets are starting to use your credit score almost like a tiebreaker. Two people apply, similar income, similar references, but one has a 720, the other has a 650. Guess who gets the apartment? And guess who's being asked for an extra month's deposit or co-signer? Or car insurance. In most states, insurers can use your credit score to set your rates, and they do. A lower score can mean you're paying hundreds more per year, even if you've never filed a claim. You're not being judged on your driving, You're being judged on your financial profile. The real problem starts when these systems overlap. Let's say you're trying to move because rent went up and you can't afford your current place. You apply for a new apartment. Landlord pulls your credit, sees a couple of late payments from when you had that car repair emergency 6 months ago. Now they want an extra deposit, but you don't have that extra deposit because you're already stretched. So you stay where you are and keep paying rent you can't afford. Or you move somewhere cheaper, farther from work, and now your commute costs eat up what you thought you'd save. It's a loop, and the tighter these systems get, the harder it is to break out. So what do you actually do? First, understand what's being tracked. If a lender or landlord is using alternative data, ask what they're looking at. Some will tell you, some won't. But it's worth knowing if they're checking your bank account activity or just your rent history, because that changes what you need to clean up. Second, if you've got steady rent or utility payments and a thin credit file, look into services that report those payments to the credit bureaus. Experian Boost, for example, lets you add utility and phone bills to your report. It won't fix everything, but it can give you a small bump if you're hovering right around a cutoff score. Third, and this one's not fun, but it's real, start thinking about your bank account the way you think about your credit report. If overdrafts or low balances are part of the picture now, that means keeping a small buffer in your checking account isn't just smart budgeting anymore. It's part of your financial reputation. I'm not saying that's fair. I'm saying that's where this is going. And finally, if you're applying for something big, a lease, a loan, a mortgage, check your credit report first. All three bureaus. Look for errors. Look for accounts you didn't open. Look for late payments that shouldn't be there. Dispute anything that's wrong. It takes time, but it's free, and it can make a real difference. One more thing. Don't assume you know where you stand. I've talked to people who thought they had good credit and were shocked when they got denied. I've talked to others who thought they were screwed and got approved. The system's not as predictable as it used to be. So check. Know your number. Know what's on your report. Don't guess. Look, credit scores aren't disappearing. They're just becoming one piece of a bigger, messier puzzle. And while that could mean more opportunity for some people, for a lot of folks, especially people dealing with tight budgets, irregular income, or past financial hits, it just means more ways to get penalized. The rules are changing, and the people who understand the new rules early are the ones who will have the best shot at navigating them. So stay informed, check your credit, know what lenders are actually looking at, and don't let anyone convince you the system's getting easier just because it's getting more complex. Real security comes from understanding the rules, even when they feel like they're stacked against you. If this helped, hit subscribe. We're cutting through the noise on this channel. No hype, just the truth about money in America. See you in the next one.